A butcher, a banker, and a bartender walk into a bar. The butcher says, "My meat prices are up 12%. The banker says, "My bonuses are up 40%. The bartender says, "My rent is up 18% and my savings are worth less than last year." The banker buys a round of drinks. The butcher and the bartender split the tip. That's not a joke. That's the American economy since 2020. Here's the thing. In December of 2025, the Federal Reserve quietly ended its multi-year campaign of quantitative tightening. They didn't send you a letter. They didn't run a Super Bowl ad. They just stopped. And when I say quietly, I mean front page, news to nobody, quiet. Meanwhile, your grocery bill knows. Your rent knows. Your savings account definitely knows. The question is, do you? So here's what I'm going to explain. How money actually works in this country. Why the system keeps getting reset every time wealthy people need a bailout. And what you can realistically do about it before the next reset lands on your lap. No conspiracy theories, just incentives. No get-rich-quick nonsense, just the boring documents nobody reads. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data link in the description. Let me tell you about a guy named Marcus. Marcus works in logistics, makes about $78,000 a year, lives in Ohio, does everything right. He saves 15% of his income in a high-yield savings account. He avoids credit card debt. He even has a small emergency fund. Marcus thinks he's playing it safe. Marcus is getting robbed, and the thief has a nice office in Washington. Here's how the scam works, and I need you to really picture this because it's the central metaphor for everything that follows. Imagine a poker game. 7 players. The dealer has a printing press under the table. Every time the game slows down, the dealer prints more chips and hands them to the biggest players. The big players bet bigger. The pot grows. The small players think, wow, the game is booming. But here's the catch. Every new chip makes all the existing chips worth slightly less. The small player stacks shrink in real value, while the big player stacks grow in nominal value. The dealer calls this stimulus. The small players call it inflation. The big players don't call it anything because they're too busy buying vacation homes. Now, you might be thinking, okay, but this sounds like crypto bro nonsense. The Federal Reserve doesn't just print money for rich people. And to be fair, that's technically true. They print money to buy assets. But here's the awkward part. Who owns the assets? Let me introduce you to something called the Fed balance sheet. Back in early 2020, the Federal Reserve owned about $4.2 trillion in assets. Bonds, mostly. Mortgage-backed securities. Treasury notes. Then the pandemic hit. The economy seized. And the Fed went absolutely feral with the printing press. They didn't just print a little money. They printed another $4 trillion in about 2 years. By early 2022, their balance sheet had exploded to nearly $9 trillion. Now, here's where it gets really interesting. When the Fed buys bonds, they're not buying them from you. They're buying them from banks, from institutional investors, from the kinds of entities that already have millions or billions in assets. The Fed hands them cash, the banks take that cash, and they do what? They lend it out, they invest it, they buy stocks, they buy real estate, they buy anything that appreciates faster than the inflation they just helped create. Meanwhile, Marcus in Ohio is still saving 15% of his salary in a savings account, earning 3% interest, while inflation runs at 4%. He's losing 1% a year in real terms and feeling responsible about it. This is the first level of the reset, the asset inflation phase. Let me give you some numbers. Between 2020 and 2022, home prices in the United States jumped by roughly 30% nationally. In some markets, it was 50%. Now, if you already own a home, congratulations. Your net worth just exploded. If you were trying to buy your first home, good luck. Your down payment requirement just went from $60,000 to $90,000 while your salary may be increased by 5%. Same story in the stock market. The S&P 500 returned 18% in 2020 and 28% in 2021. Those are not normal returns. The historical average is about 10%. But when you inject $4 trillion, of new money into the financial system, a lot of that money finds its way into equities. The people who own stocks got significantly richer. The people who don't own stocks got significantly poorer on a relative basis. But here's the thing. You might be thinking, okay, but inflation hurts everyone, right? Rich people pay more for groceries too. Technically, yes. But this is where the poker game metaphor really matters. If your net worth is $10 million and inflation is 7%, your cost of living might increase by $30,000 a year. But if your assets appreciate by 15%, your net worth grows by $1.5 million. You're not hurt. You're inconvenienced at worst. If your net worth is $10,000 and inflation is 7%, your cost of living increases by $3,000 a year, and your savings earn 2%, you're falling behind every single month. Now, here's the second level of the reset, the policy reversal. By mid-2022, inflation had hit 9%, the highest in 4 decades. Suddenly, the same people who spent 2 years printing money like it was going out of style started panicking. The Federal Reserve announced quantitative tightening. They stopped buying bonds. They started letting bonds mature without replacing them. They raised interest rates at the fastest pace in modern history. The poker dealers stopped printing chips and started taking them off the table. Between early 2022 and late 2025, the Fed's balance sheet shrank from $9 trillion to about $6.5 trillion. They removed $2.4 trillion of liquidity from the financial system. Now you might be thinking, great, so they fixed it. Here's where it gets really interesting. They didn't fix anything. They just paused. In December of 2025, the Federal Reserve quietly announced they were ending quantitative tightening. Not because inflation was back to 2%. It was still around 3%. Not because the economy was booming. Job growth was slowing. They ended it because the banking system was getting twitchy. Let me explain what I mean by twitchy. When the Fed removes liquidity from the system, banks have less money to lend. When banks have less money to lend, they get pickier about who they lend to. When they get pickier, credit tightens. When credit tightens, businesses can't expand, consumers can't borrow, and the economy slows down. Slow down too much, and you get a recession. The Fed is terrified of a recession, so they stopped tightening. But here's the problem. They never actually dealt with the underlying issues. They just pumped the brakes. This is where the third level of the reset comes in, the quiet bailout. On December 11th of 2025, the Federal Reserve announced something called reserve management purchases. Now, the Fed was very careful to say this is not quantitative easing. This is different. Quantitative easing means buying long-term bonds to push down interest rates. Reserve management purchases mean buying short-term treasury bills to maintain liquidity. Here's a joke for you. What's the difference between quantitative easing and reserve management purchases? About 6 months of semantic gymnastics. Both involve the Fed buying assets. Both involve the Fed creating money to do it. Both expand the Fed's balance sheet. Both inject liquidity into the financial system. But one of them sounds scary and the other sounds boring. The Fed chose the boring one. Now, to be fair, the scale matters. The Fed was very clear that reserve management purchases would be limited to maintaining adequate liquidity, not aggressive stimulus. But here's the thing about limited programs. They have a funny way of becoming unlimited when things get bumpy. We saw this in 2020. We saw this in 2008. The pattern is remarkably consistent. Crisis, bailout, reassurance that it's temporary, gradual expansion, and then suddenly we're looking at a $9 trillion balance sheet. Let me tell you another story. In the late 1990s, there was a company called Long-Term Capital Management. They were the smartest guys in the room. Nobel Prize winners on staff. Sophisticated mathematical models. They borrowed billions to make bets that seemed low risk. When the bets went wrong, the Federal Reserve orchestrated a bailout. Not because they cared about the partners at Long-Term Capital, because they were terrified of what would happen to the banking system if those bets unwound. The lesson everyone learned was simple. If you're big enough and you fail loudly enough, the system will rescue you. If you're small enough and you fail quietly, the system will ignore you. Marcus in Ohio loses his job and can't pay his mortgage? The system says he should have planned better. A major bank makes terrible loans and faces insolvency? The system finds $300 billion overnight to keep the lights on. This is the fourth level of the reset, the political capture. Now, I want to be careful here because this isn't about blaming any particular politician or party. The incentives are bipartisan. Every politician wants low interest rates. Low interest rates make borrowing cheap. Cheap borrowing means more spending. More spending means a growing economy on paper. A growing economy on paper means happy voters. Happy voters mean re-election. Jerome Powell's term as Fed chair ends in May of 2026. The incoming administration has been very vocal about wanting lower rates. They've made it clear they want a Fed chair who's more, shall we say, cooperative. Now, the Fed is supposed to be independent. The whole point of having an independent central bank is that politicians shouldn't be able to print money whenever they want to buy votes. But independence is a fragile thing. It relies on norms and traditions and a shared belief that short-term political gain shouldn't override long-term economic stability. Those norms have been eroding for decades. Here's what you need to understand about the next few years. The pressures on the Federal Reserve are going to be immense. You have a political class that wants cheap money. You have a financial sector that loves asset inflation. You have a government that's running trillion-dollar deficits as far as the eye can see. And you have a population that's gotten used to the idea that every market dip gets rescued. The path of least resistance is more printing, more liquidity, more asset inflation, and more wealth concentration. But now you might think, okay, so what do I actually do? This all sounds depressing. And look, I get it. The system feels rigged because in many ways it is. But understanding the system is the first step to not getting crushed by it. Let me give you a concrete example with real numbers. Let's say you have $50,000 sitting in a savings account earning 4% interest. That's $2,000 a year in interest. Not bad, right? But let's say inflation averages 3.5% over the next decade. Your real return is 0.5%. After taxes on that interest income, you're probably losing money in real terms. Meanwhile, let's say you invested that same $50,000 in a diversified portfolio of stocks and bonds that returned 7% annually. After 10 years, your $50,000 becomes about $98,000. That's a $48,000 difference. And that's before you consider that stocks tend to act as a hedge against inflation because companies can raise prices. Now, here's a comedic cutaway for you. Imagine explaining to your grandchildren that you kept your money in cash because the stock market seemed risky. Grandpa, you lost $48,000 to inflation. Yes, but at least I didn't lose it all at once like those crypto people. Grandpa, the crypto people are on yachts. But seriously, let me tell you about two piles. I want you to imagine that your wealth is divided into two piles. Pile one is your labor, your salary, your wages, your hustle. Pile two is your capital, your investments, your assets, your ownership stakes. The entire history of the American economy for the past century can be summarized as follows. Pile one has been steadily losing ground to inflation and tax policy. Pile two has been steadily gaining ground through asset appreciation and favorable tax treatment. The rich understand this intuitively. They don't work for money. They own things that generate money. When the Fed prints currency, it flows through the financial system first, inflating asset prices before it ever reaches consumer goods. By the time Marcus in Ohio sees higher prices at the grocery store, the institutional investors have already bid up the price of everything from farmland to futures contracts. Here's another comedic cutaway. The Federal Reserve has a dual mandate from Congress: maximum employment and stable prices. That's like telling a restaurant they need to serve maximum portions and maintain minimum calories. At some point, you have to pick one. Now, I want to address something you might be wondering. Is this just going to be a video telling me to buy index funds? And the answer is mostly yes, but with some important caveats. First, index funds are not magic. They're a bet on the continued growth of the American economy. They work because corporate profits tend to grow over time and stock prices tend to track corporate profits. But they don't protect you from everything. In a severe economic crisis, stocks can fall 50%. If you panic and sell, you lock in those losses. The key is time horizon. If you're investing money you'll need in 2 years, stocks are the wrong choice. If you're investing money you won't need for 20 years, stocks have historically been the best choice. Second, not all index funds are created equal. Expense ratios matter. Tax efficiency matters. Asset allocation matters. A target date fund that charges 0.08% annually is very different from an actively managed fund that charges 1.2% annually. Over 30 years, that difference can compound to hundreds of thousands of dollars. Third, and this is the one most people ignore, you need to understand your own psychology. The biggest risk to your portfolio isn't the Federal Reserve, it's your own brain. When markets are crashing, your instincts will scream at you to sell. When markets are booming, your instincts will scream at you to buy more. Both instincts are usually wrong. The people who build real wealth are the ones who can sit still while their emotions are screaming. Let me tell you about a study I read. Researchers looked at the trading records of thousands of individual investors over a long period. They found that the most active traders, the ones who bought and sold most frequently, earned the lowest returns. The least active traders, the ones who bought and held, earned the highest returns. The difference was about 7 percentage points annually. 7 percentage points compounded over 20 years is the difference between retiring comfortably and retiring on time. This is why I keep coming back to the 2 piles framework. Your labor pile is active. You work, you get paid. Your capital pile should be passive. You buy, you wait, you rebalance occasionally, you wait some more. The temptation to treat your capital pile like your labor pile, constantly buying and selling and tinkering, is exactly what the financial industry wants from you. Every trade generates fees. Every panic generates spreads. The house always wins. Now you're asking yourself, what about the next crisis? What if they really do reset the currency? What about central bank digital currencies? And these are fair questions. Let me address them one at a time. Central bank digital currencies are a real thing that's being explored by governments around the world. The Federal Reserve has published papers on the topic. The European Central Bank is actively researching it. China has already launched a digital yuan. The technology exists. The question is whether it will be implemented and what form it would take. Here's the honest answer. I don't know. Neither does anyone else. The Fed has said they wouldn't issue a digital currency without congressional authorization. Congress is divided on the issue. There are legitimate privacy concerns, legitimate financial stability concerns, and legitimate questions about how a CBDC would interact with the existing banking system. This might happen in 10 years. It might never happen. What I can tell you is that panicking about it today won't help you. The same strategies that protect you against inflation, diversification, owning real assets, maintaining a long time horizon, are the same strategies that would protect you in a world with central bank digital currencies. What about a currency reset? This is the scary scenario that some people talk about. Hyperinflation, the dollar loses its reserve currency status, the government issues a new currency, everyone's savings get wiped out. Look, I can't tell you this is impossible, but I can tell you it's extremely unlikely in the near term. The dollar is still the world's reserve currency. Roughly 60% of global foreign exchange reserves are held in dollars. About 88% of foreign exchange transactions involve the dollar. The entire global financial system is built on dollar liquidity. If the dollar collapses, it's not just Americans who suffer. It's everyone. Now, could we see high inflation? Absolutely. We just saw it. 9% in 2022. Could we see inflation return if the Fed prints another $4 trillion? Absolutely. Could we see a slow, steady erosion of purchasing power over decades? That's basically the history of the dollar since the Federal Reserve was created in 1913. A dollar from 1913 is worth about 3 cents today. But that happened gradually, over a century, while wages and asset prices also rose. The question isn't whether the dollar loses value. The question is whether your income and your assets keep pace. Here's what I know for certain. The Federal Reserve is not going to send you a letter saying, hey, we're about to print a bunch of money and your savings are going to lose value, so you should probably buy some stocks. They're not going to warn you. Their job is to maintain the stability of the financial system, not to protect your personal purchasing power. That's your job. Let me give you 3 practical takeaways. These are not generic. These are specific actions based on everything we've discussed. First, calculate your own personal inflation rate. The consumer price index is an average. Your actual inflation rate might be higher or lower, depending on what you spend money on. If you're planning to buy a house in the next 5 years, Housing inflation matters more to you than egg prices. If you're retired and on a fixed income, healthcare inflation matters more to you than used car prices. Understand your own exposure. Second, automate your investments. Set up automatic contributions to a diversified portfolio. Make it boring. Make it invisible. The less you think about it, the less likely you are to make emotional decisions. The poker game is designed to separate you from your chips. The best way to protect yourself is to not play. Third, understand your time horizon. Money you need in the next 2 years should not be in stocks. Money you don't need for 20 years should probably be mostly in stocks. The biggest mistake I see people make is having the wrong assets for their timeline. They keep their retirement savings in cash because they're scared of market volatility. They put their emergency fund in crypto because they want high returns. Both are wrong for opposite reasons. Lazy investing built more fortune than crypto memes. Not because lazy investing is exciting, because lazy investing lets compound interest do the work while you focus on things that actually matter to you. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Let me come back to the butcher, the banker, and the bartender. The butcher raised his prices. The banker bought more assets. The bartender started investing. Two of them are doing fine. One of them is still complaining about the system while getting crushed by it. The system isn't fair. The deck is stacked. The dealer has a printing press. But you already knew that. The question isn't whether the game is rigged. The question is whether you're going to learn the rules or keep pretending you can win by playing the same old way. The next reset is coming. Maybe it'll be a bailout, maybe a rate cut, maybe some new acronym for printing money that nobody's invented yet. When it happens, the people who own assets will be fine. The people who don't will wonder what happened. Don't be in the second group.